testing. JB here. Let me just get on the audio. JB here. Hope everybody's doing outstanding on this January 24th, 2022. I'm not going to be on too long here. Obviously, the market is under pressure. The futures opened higher overnight. Thought maybe we can get some kind of bottom in, or at least short term, get a bounce for a couple days into the Fed meeting on Wednesday, and wake up in the morning to see that not only did the futures erase all the gains, it went solidly into the red, gap down over 1%, and the NASDAQ is down about 2.7% today. So I'm not going to sit here, get the bear suit on. S&P's in correction territory now. It's at some point you would have to think the NASDAQ's going to be in bear market territory, and then you'll hear all these headlines and narratives, market crash coming, whatever the case may be. But on the flip side, I don't want to be in a position where I don't take advantage if something does happen, right? So this morning I started to look at some of the triple ETFs. If you traded in 2008, 2009, stories for other days, but ticker SKF, ticker SRF, ticker FAZ, they all went parabolic, crazy. I think at one point SKF was $20 by the time it hit December and January, December of 2008 and January of 2009 and February. It was like $300, $400. It was moving $100 every day. It was crazy because those instruments are very weird how they get weighted. So that hasn't, of course, those haven't been good instruments for the last 13 years because a function of what happens with the rebalancing is they lose value every day. So they're not they're not an investment tool. But in times of volatility where there could be more selling pressure, things like that, these 3-time bear ETFs could be, could pay off pretty well and offset losses if you're long positions, things like that. So I was looking at a ticker like DRV, which, you take a look at REITs and some of the tickers that make up I think it's the MSCI Real Estate Index, I think is what it bases it off. So it trades 3 times the opposite to how that performs. And you have to think that if the market continues to have some pressure, those names will certainly not do well. And then you take a look at the DRV, which is up quite a bit already. It's at 45.54 now. That's a name you look and it's like, well, maybe it's 75 or $100 over the course of a couple days, especially if the market continues to have pressure. So that's one name I'm looking at. FAZ, obviously FAZ is a 3-time bear financial ETF. Financials getting destroyed today, and you take a look at Goldman Sachs. I mean, it seems like just yesterday it was under $200. Then it was up near $400. Then it had its earnings, and the earnings weren't actually that bad, but the stock's been selling off. Maybe the financials continue to come under pressure. And you would think in a rising rate environment, the financials should be the sector of choice because rising rates are good for the financials, right? They make more money. But maybe that's some of it's already priced in, or who knows if the market's pricing in pressures, defaults. As some of these, there's been forbearance. Some folks who haven't paid their mortgage based on COVID, those restrictions are coming away. So maybe there's going to be a slew of bankruptcies and foreclosures and things like that. Who knows? And obviously that would weigh in on financial stocks. But those are some of the things I'm looking at. I don't want to be in a position where I hold too much because if you traded anytime, 2015 was a great example back in the summer when we had China having its first default ever and futures were limit down and crazy stuff on 2015. I think 2013 in the summer was 2011 maybe. It was the U.S. debt downgrade. That was another huge volatile segment of time where some of the stocks you would look back before Priceline. I don't know if the Priceline had it was called Price. It's Bookings.com, and it was Priceline, Bookings Group. Priceline was like $800, and then in a month's time it was down to $300. So you would look around, and a lot of kind of same things you see here today is you look at some of these stocks that were, SE Global, great example, 300 plus stock, and all of a sudden just destroyed. And it's like nothing's really changed. There's no huge catalyst. It's just as rates go up, of course, to have access to capital, especially if you're looking to grow scale and things like that, and you're not a profitable company, it becomes more expensive. So you have to start refactoring earnings and things like that. So, but those are some of the things I'm looking at. Yeah, I mean, the other issue is premiums are expensive. So you take a look at a stock like Palo Alto, which I was looking $100 and something ago on the put side, but the premiums to play on the weekly puts, you go down to $400, which is a 15% decline over the next 4.5 days, and it's what was it, $1.40, $1.50. So the risk reward is kind of it's a little tougher here. So that's why I'm kind of looking at maybe some ETFs to kind of find decent risk reward setups. Some FAS, maybe 25 calls, weeklies, or even next week 26s. So those are some of the things I'll be looking at. Because if things do escalate to the downside, these 3-time Bear ETFs, they go parabolic. So FAS is 22 now, 21.95. Tomorrow will be 25, then it'd be 35, and then it goes 50, then it goes 70, so on and so forth. And of course, those are bad scenarios, right? I don't want to see the market crash. Not good for anybody to see the market sell off. But at the same token, we trade. So I got to trade what the market gives me. And if it's to the downside, I certainly don't want to miss out on that opportunity. And some of the biggest the most profitable trades are on the downside, right? You could play calls for the last 12 years, and then puts might pay off over a course of 3 or 4 days. So we'll have to see how this plays out. Again, I'm not getting my bear suit on. I was going to put on a watch list this morning. I used to track the VIX. So the VIX would, if it broke the upper Bollinger Band and closed above it 2 times, usually it portends a reversal, and it did it this past week, and that hasn't happened. So that's kind of a little concerning. We do have the Fed on Wednesday. You have to think with what's going on in Ukraine, what's going on, on the inflation front and what have you, and of course with the markets, that Powell's probably going to try and backstep some of his hawkish commentary from the last meeting and the last Fed minutes, and maybe try to ease some concerns. So maybe Wednesday is the bounce day, or maybe the end of today. We'll have to see. But certainly, setting up for some interesting trading days ahead. We have earnings as well. I was looking at IBM. I've traded IBM on and off for quite a few years, not thinking that it's going to get back to its previous glory. But here's a company that's bought back so much stock. The amount of outstanding shares are substantially less than where it used to be. So just as a function of the buybacks, I thought the stock should be higher. Of course, it's more competitive. There's a lot more folks in all the businesses that IBM has their hands in. But maybe they didn't announce something in regards to Watson, or they're going to sell that off. Who knows? And you take a look in December, it was a value run up. So in December, all the stocks most of the stocks in the Dow ran up based on the possibility of rising rates, because those companies become more attractive, especially companies that have dividends, things like that. But then it just recently sold off. So maybe after the close today, a decent earnings report, they in line or even raise guidance just a little bit, and the stock maybe it's up 5 or 10%. So may get some calls into the end of the day just on that. And I think that's it. That's my rant for right now. I'll try and get back on later if I add any of these 3-time ETFs. DRV, definitely looking at that one. FAZ, SKF, SRS. SRS is the real estate one. SPG I was looking at in regards. It's been on quite a bit of a tear, and I think it's down over 10% today. Let's see. But premiums it's just too hard to play. It's only down 4.5% now. You go down, it's like the 120s and 110s on a weekly put strikes are insanely expensive. So not only is it down 4%, but then you have to hope that it goes down another 10% plus this week, which was tough. I used to say this a lot too. It's not fun being a bear. Well, it is fun if you're making money, right? But it's not like you go to see the barbecue next door or your friend's house and tell them, I'm loaded on puts. I hope the market crashes, because market selling off is not good for everybody. But again, got to trade what the market gives you. So I can't sit here and sit on my hands and wait for a bounce. So at some point, I'll probably look for some positions to play for downside. A Zebra was the other name. I actually had the 480 puts. I sold those for double. I think it was a double. And then they closed in the 490s on Friday. And sure enough, what is it? The day after expiration is down at 470. That's another name. Some of these stocks you have to think are just going to sell off, not based on fundamentals, growth, earnings, just because a rising tide raises all ships. As the tide starts to go out, all the ships are going to go down, right? Palo Alto, same similar story. Great earnings, huge gap to the upside. I think it held up pretty well the first couple weeks of the sell-off, and it's just been last couple sessions been under pressure. Here it is at 460. Maybe that goes down to $400. So I'll try and get back on later. Let's have a great day. I'll be back. Rock and roll.